Existing home sales plunge as China's real estate crisis and dollar shortage problem gets worse. The U.S. may be on the verge of popping its own housing bubble at a time when most investors are short crash insurance. And a fan asked, why is the mainstream media pumping rates when the pros say, no way? Answer those questions and more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today as we pick back up this story coming out of China, which is looking like another major real estate crisis that starts to look like the great financial crisis, except now centered in China. And what we're seeing in the news is exactly what we predicted would happen when a lack of confidence hit the buyers and they turned into vanishing act. Check this out as we head over to Bloomberg. Their home sales slumped by 17% as Evergrande saga deters buyers. Wow, what do you know? When the person you might be or company you might be buying a property from is having financial troubles, what do people do? Well, they run. The sales slide in September follows a 20% plunge in August, and we're seeing real estate investment down for the first time since last year. Here you can see again, home sales by value tumbled 16.9% in September from a year earlier, following a 19.7% drop in August, which is incredible. Again, this is exactly how we saw the housing bubble pop in the U.S. The property slowdown is one of the many headwinds facing the Chinese economy, which say growth slowed last quarter. Well, growth slows in the largest exporter. Guess what it's coming to? The largest importer. And just as we predicted, here you can see, quote, no one is buying new properties because they're afraid, quote, Helen Gao, the chief, and I apologize if I got her name wrong, Greater China economist at Bank of America Corp, said in an interview on Bloomberg Television, quote, so we could see further downside in the economy. And there you go, the sales slump, and they fuel a vicious cycle by worsening the cash shortage. Funny how this is all coming to fruition at developers and forcing them to offer bigger discounts. What do you know? This in turn could reduce home prices in a country where people keep a large chunk of their value in real estate, and property stocks, no surprise, declined on the report. Now then it gets even worse because we've got Goldman's report saying that existing home sales crashed by 63%. Let's take a look at this from Zero Hedge. Goldman's hard landing scenario, which saw total sales of 760 billion yuan, plunged 36.2% from September 2020, deepening a downward spiral that started in July with residential transaction volumes plummeting across the board. Now let's go down further into its report from Goldman, and here we see that the downturn continued this month. Check this out. With existing home sales crashing 63% from a year earlier in the first 17 days in October, according to a Nomura note on Monday. And then, quote, the new home market faces relatively big downward pressure in the near term. So research director from the China Real Estate Investment Corp. This is a huge problem. Again, you start looking back to the great financial crisis, and what did you see? You saw a loss of confidence leading to lower prices, and next thing you know, you get delinquencies and defaults. But does it stop there? No, it doesn't, because the Chinese property slump extends into September back to the Wall Street Journal now. And what did we see? That the developers, here you see debt-saddled developers are cut spending and demand from home buyers wane. Now, exactly, this is how the whole system starts to fall and how you get that tipping of the dominoes. As people stop spending money, then developers stop spending money as well. And the same thing in the consumer market. When consumers stop spending, then factories start cutting production and inventories start building up on shelves. It's a confidence game. And that's why this is so critical, because it could get worse as Xi Jinping looks to put in a property tax to curb speculation. He said he's made no secret his desire to inflate the Chinese property bubble, here according to the Wall Street Journal. But according to people with knowledge of government deliberations, he is facing resistance over a measure aimed at curbing housing speculation, a nationwide property tax. So can you imagine if he were to enact that, what that would do to an already ailing real estate market in China? it would literally just topple the whole thing over, because we already have the issue that these property developers are missing their debt payments. And now we see Evergrande continuing to make its onshore or yuan-based debt payments as offshore creditors, dollar-based debt holders, brace for an official default. And we're seeing more and more of this coming from Reuters, that the Henga Real Estate Group, Evergrande's flagship unit, has remitted funds to pay an onshore bond coupon of 121.8 million yuan due on Tuesday. Citing sources, Reuters noted that the company needs to prioritize its limited funds toward the domestic market, this being driven by Beijing, where the stakes are much higher for the country's financial system. So as we talked about before, they are actually going to let the dollar-denominated bonds, looks like they're headed to default as they try to stabilize the local market and try to regain confidence. It makes sense, not from an investment standpoint, from where they're at, is you can't prop this up. But if you can get people to come back and buy, cash flow returns these companies, now you can come back and make the payments on your dollar-denominated bonds. Now, if you're concerned about this risk from a portfolio perspective from your investments, hey, take a chance to take a look at Portfolio Shield, which is a unique strategy that I created that has probably one of the best hedging mechanisms out on the market today. You can check that out at portfolioshield.net. There's also a link in the description below, because where we get now is that this is turning into a dollar shortage, something we've talked about as well. Here you see breaking news: China's Ministry of Finance begins the sale of dollar bonds. Now let's be clear of what they're doing. They're issuing bonds to get dollars. So they actually want dollars. So they say, hey, take our bond, we want your dollars. And that only adds to the dollar shortage. And so when you see where this is going, well, now you've head back over to zero hedge. You get this headline that China's U.S. Treasury holdings plunge to 10-year lows after dumping in August. And this gets, of course, people to sell bonds because they think interest rates are going up. But what this means is China is short dollars. And I want you to understand how they get dollars is through global trade. And we're going to expand upon this in a moment. So when they need dollars, what do? They sell treasuries. So when the global economy is functioning and the global monetary system is functioning and consumption is rising, they don't have a problem getting dollars. They get them through trade. When that is not working, they need to sell them. This doesn't mean rates go up. It generally actually means rates go down. This is something we learned from our friend Jeff Snyder, who talked a lot on his show with Emil Kalinowski. Check him out on YouTube. That when you see them selling, when you see foreigners selling bond treasuries, it's a sign of disinflation or deflation. Here, let's take a look at the tick data that comes out. Now, this is a lagging report. It shows August. We see China's numbers are down, but overall treasury holdings were up. What did drop were foreign officials. These are more along your central banks. They actually did sell. And you might be wondering, why is China selling if the Fed came out with a standing repo facility to alleviate this? Well, guess who doesn't have access to it? Yeah. Do you think the Fed is going to allow a communist country access to the SRB? Not a chance. And they certainly didn't. So again, now let's get back to how China gets dollars and why this is a problem, because it doesn't appear that their dollar shortage is going to go away anytime tomorrow, particularly when you see these headlines here of Factorygate prices rising at a record pace. Now, you might say, well, that will be good to help them get dollars. Well, maybe, because these costs are going to be passed on to U.S. consumers and other people around the world. But you'll see here the producer price index rose by 10.7% in September, which is huge. Now, they're not passing all of these increases on to consumers, but the other side is if consumers can't afford higher prices, then these goods get stuck on shelves and China doesn't get the dollars they need. Plus, you go to this article, China's magnesium shortage could spell more trouble for the global car industry. Well, if they're short something, guess what they don't have to sell? They don't have magnesium or don't have as much. Guess what you can't get? You can't get dollars. And so the problem in China's real estate market is going to likely get worse and could stem the next financial crisis. And again, at a time which we're going to get to, that investors just don't own any crash insurance. Before we get to that, let's hit the U.S. housing market, where we see housing units started fell 1.6% month over month. Not a really big deal. You see this happen from time to time, but what is a big deal is building permits dropped 7.7% month over month. And that, as you can see here from this chart, is a pretty sizable decline. Now remember, permits tend to lead starts. You can't start a home unless you got a permit to build it. And so let's go on, and you can see that both permits and units started are starting to peak and roll over, a sign of potential risk to the U.S. housing market. And we can see that here in this home builders' confidence is way off the chart, and home buyers' confidence is down here. Now, of course, what would that lead to is a similar story in China, where you see U.S. buyers starting to reject higher prices. And what else are they rejecting? Well, they're rejecting higher interest rates too. So let's talk about that real quick. Here you can see, and we'll come back to this chart here in a second. I think I got it out of order. Here you see the U.S. mortgage market index, and I pulled this history back so you can see the amount of people refining and buying and getting mortgages is still relatively high compared to normal times, but it is falling, my friends, and we're almost back down to we could see some of the lower levels from the pandemic. You see us rolling over and heading lower. And as someone who used to work in the mortgage industry, I can tell you they're one of the first groups that are hit, and they are not shy about laying off. So if you start to see less demand in mortgages, what does that tell you about interest rates? They're too high. That is the key. When rates go up and there's no demand to match them, then all of a sudden you have a problem where speculators are driving rates too high. Now, to our fans' question of why is the mainstream media pumping rates when there are experts out there, such as myself, saying, no way, this can't happen. Well, it's because they think what's going to happen isn't actually going to happen. They're looking back to the 70s. But what I want, before we show you that chart, I want you to understand that the whole idea of speculating on the bond market or any market works like this. If you think rates are going higher and you want to profit on it, you would short the bond market. That's what you would do. Because what you're hoping that in the future, there is someone who wants to transact and borrow money at a higher rate. And then when they do, that means that bond prices will go down further and you'll capitalize and profit on your speculation in the bond market. The problem is, what happens when there's no one who wants to borrow at higher rates? And then you find out that a bunch of speculators are the only one that wanted to be shorting bonds, and now all of a sudden you get a massive unwind. So let's look first at the history of rates and consumer prices. And the belief is that when consumer prices rise, as you see here in blue in the 1960s and 1970s, well, gosh darn, 10-year treasury yields went up and they looked like they lagged it. So of course, that means this big move here in the CPI must be met by a colossal move in 10-year treasury yields, maybe up to 5% even, But look back, when have we seen that since? Have we seen consumer prices drive rates higher? No, in fact, during the great financial crisis, consumer prices went up and yields went shockingly down, completely opposite what everyone's expecting. And the reason why things are different now, and hopefully for the fan who asked the question, this answer is that back in the 60s and 70s, you had something called the money multiplier, which was rising. Now, what is the money multiplier? It's the money supply, the M2 divided by the monetary base, or MB. Monetary base is made up of nearly entirely the Fed's balance sheet. So what you're seeing in the 70s is the supply of money was growing faster than the Federal Reserve's balance sheet. Now, granted, the Federal Reserve wasn't really expanding their balance sheet like we see today. And so as the money supply expanded, you get inflation. But when you have the opposite, where you're starting to see the money supply not growing real quickly relative to the monetary base, then you get disinflation or deflation. So when you look at this chart in blue, you see the money, what's called the money multiplier, and then in red you see 10-year treasury yields. The reason treasury yields are not going higher is because the money supply is not growing fast enough relative to the Fed's balance sheet to do that. So the probabilities of higher rates are and remain extremely low and highly unlikely, although speculators will likely continue to short them until they find out they're on the wrong side of the trade. Anyways, let's continue on. We have investors not positioned for a risk-off event as China looks to implode and just a sharp disaster of a real estate bubble. And what do we see here? This from Bank of America Global Fund Manager Survey is, and again, this is fund managers. This is not your regular people. These are money managers, and it says their most pessimistic outlook for bonds in the history. Well, man, that is music to Bond King's ears. So let's take a look at this. And what do you see? They were very pessimistic in July of 2007. In fact, let's pull up a chart of yields for fun. Let me do that in the background while you hang tight for a second. And let's go and look at, they were July of 2007, and then we'll go February 11. So let's pull that up. July of 2007 on the 30-year. So where's 2007? Here we go. And they were real bearish on yield. Oh, they're real bearish on them at the peak. Okay, there you go. And then what did we say the next one was? February 11. Let's see. It's probably right in here. So they were bearish near the peak again. And how about we go to September of 2012? Is that right? September 13, September 13 and February 18. So September 13, probably, let's see, right down here. Nope, they're up in here. So as yields were rising again to a peak, they were bearish, and then they rolled over. And February of 18, well, that we know that didn't work out because yields were soon to peak afterwards. And guess what? They are back at it again, telling you that we're most likely near a peak in yields and rates likely headed lower. Then we had, of course, today's 20-year bond auction was considered fairly poorly received, and that's simply because the bid to cover number of bids against the offer was below the 6-month average. But what matters is the details, and that is there was still strong foreign demand right on par with last month's auction. And of course, the bond market had a negative reaction to that, but again, won't last long, because as we look into speculative positioning, we see 10-year Treasury bonds net speculative positioning by is positive, and that is normal when you see 6 months is the look back period, the most popular look back period in algorithmic products. When you see the 6-month return higher than it was 6 months ago, they're going to start allocating. Now, what we do see is still some negative pressure on the 30-year down here. Again, thanks to Hedgeopia, they're still net short, and my guess is we'll see an increase in that net short position by next week. So with that, let's take one quick look at what's going on around the world with inflation. And here we have Great Britain. What do we see? Core, excluding food and energy, CPI up 0.4%. So slowing, it's disinflationary over the prior month. Still on the hot side, but looks to be cooling. How about their broad CPI, including food and energy, also disinflationary down to 0.3 and more in a nominal range. Still to the hot side, but starting to cool off. How about we go to the Eurozone, where we see a little bit different picture. The core CPI month over month inflationary up to 0.5, so that is hot. And then we see the broad CPI, including food and energy, up from 0.4 to 0.5, so also on the hot side for sure. And maybe adding to that story, then we get crude oil report, and this was bullish simply because you had almost 4 billion draw of distillates and almost 5.4 billion draw of gasoline. And so with that, we'll wrap up the show. But now you can see the situation in China is bad. You can tell that people do not own crash insurance, and at a time when the data from fund managers says it's probably a pretty good time to own bonds. And with that, I'll see you back on Friday. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only, not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation, buyer selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the value of Alice Financial Advising or Steven Van Metre Financial.